Hello friends, welcome to my channel. In this video you will learn about tax on transfer of immovable property. It can be individual house, land, but agricultural land should be excluded because it is exempt from capital gain, so it will be excluded. And apartment, flat and any gains arising from transfer of immovable property will be charged under capital gain, okay, unless the property is held as a stock in trade, because many people do business in property dealings, right, buying and selling properties. Then in that case it will be charged under business head because their main work is buying and selling properties, so property is held as a stock in trade. Otherwise it will be charged as per capital gains. And in capital gains there are two kind of capital gains. First is short term capital gain. For that we have to check the holding period of the property, okay. What is the holding period? From date of purchase to date of sale, okay, that period is known as holding period. And if holding period is within 24 months, then short term capital gain will arise. And in case of long term capital gain, if the holding period is 24 months or more, okay, then long term capital gain will be arise. Why we have to bifurcate this short term and long term? Because there is an indexation benefit you will get only under long term capital gain, okay. So that's why we have to bifurcate this into short term and long term, and there is a different tax treatment for both. Now let's try to understand short term capital gain. The holding period is within 24 months. And what is holding period? Date of purchase to date of sale, okay. And in case of inherited property, we have to consider date of purchase of the original owner, okay, when they purchase that property, okay, that will be considered, not date of transfer. So that is clear. And next is, what is the tax treatment in case of short term capital gain? The short term capital gain will be added to the regular income of the assessee and taxed as per slab rate, okay. So there is no special rate of tax. You have to pay tax as per respective slab rate. It will just add into your regular income. Now let's try to understand by taking a simple example. So Mr. John, who bought 1 BHK flat in April 2020 for 25 lakhs, okay, and he sold it in November 2021 for 35 lakhs. So what is the short term capital gain? Because you can calculate the holding period, that is date of purchase to date of sale. It is obviously less than 24 months, so it will be considered as a short term capital gain of 10 lakh rupees. So this 10 lakh will be added to your regular incomes, like whatever income you have, like salary, income from other sources. So it will be added to your regular income and taxed as per respective slab rate. Now let's try to understand long term capital gain. So for long term capital gain we have to check holding period. If holding period of the asset is 24 months or more, then we have to consider it as a long term capital gain. And in long term capital gain you have a benefit of indexation, because you will not consider that original cost of acquisition. You have to pull it towards the current day value, okay, by cost inflating index, that we will understand in next slide. So we have to pull it towards current day value, so your cost of acquisition will rise and at the same time your profit will decline, because we are considering current day's value, not original value, okay. So this is the benefit of indexation, available only in case of long term capital gain, not short term capital gain. Now let's try to understand how to calculate indexed cost of acquisition. So for calculating indexed cost of acquisition, you have to multiply this original purchase price into index value of sale year and divided by index value of purchase year, okay. You can understand it better by taking example. So, and this index value is given on income tax website, so you can see index value of every year, okay. So you can easily put the value of sale year and value of purchase year, okay. So let's take an example, then you can understand it better. So Mr. Johnny, he has bought 2 BHK flat in May 2004 for 20 lakhs, okay, and sold it in November 19 for 90 lakhs. So you cannot consider this 20 lakh as a cost of acquisition, because you have to consider indexed cost of acquisition. So you have to pull it towards the current value. So let's see, the index value is given, right. So index value in the purchase year is 113 and index value in sale year is 301. So you can easily calculate it by dividing original purchase price by index value of purchase year and multiply it by index value of sale year, okay. You can see this, divided by index value of purchase year and multiply it by index value of sale year. So you can get indexed cost of acquisition, that is 53.27 lakhs. Now Now you can see the difference between 53.27 and 90 lakhs, and you can calculate LTCG, that is 36.73 lakh. Okay, and you can apply the special rate that is applicable for LTCG, that is 20%. So 20% flat will be applicable on LTCG. So the tax payable on long-term capital gain will be 7.35 lakhs. So you can see the difference between the tax treatment of short-term capital gain and long-term capital gain. First thing is, indexation is available only in case of long-term capital gain, and in case of short-term capital gain, you just have to add that short-term capital gain to your regular income and it will be taxed as per your respective slab rate. But in case of long-term capital gain, there is a special rate 20%. Okay, so you have to pay this 20%, that is 7.35 lakh, over and above your regular income tax payable. So this is the difference between long term and short term. Now let's take another example in which brokerages has been paid to the brokers and innovation has been carried out in between. So let's say he sold it in November for 89 lakhs only, because we have to deduct brokerages paid. So let's say he has paid 1 lakh brokerages to the brokers, and it is selling cost to the property. Whatever he has spent to sell that property, we have to deduct it. Okay, so 90 lakh is the sale consideration, but we have to deduct the brokerages paid to the brokers to sell that property. So net sale consideration will be considered, that is 89 lakhs only. Okay, and we have to deduct indexed cost of acquisition that we have already calculated, 53.27 lakhs, right? And let's say there is an innovation in between, the holding period has been carried out by Mr. Johnny. So in year 2010, okay, so let's say in year 2010 there is an index value of 167. So we have to pull this 4 lakh spent on innovation to current year value. So we have to divide it by index value of innovation year and multiply it by index value of sale year. Okay, so now you can get 7.2 lakhs. So you have pulled this 4 lakh into current value. Okay, so this is how you have to do in case of innovation in between holding period. So indexed cost of improvement you have to deduct it too. So the long term capital gain will be 19.53 lakh, and you have to pay 20% on 19.43 lakhs, that is 3.9 lakh is the tax payable on this long term capital gain.